I was supposed to owe the IRS 1.4 million, and I ended up only sending them 200,000. Great. The better story is, hey, I was supposed to have 13 million. Now I have almost 20. So if you sell your business for $5 million, you'll owe about 1.4 million. But we can implement strategies that will help to reduce that number and, more importantly, enable you to take those tax savings and invest them into the market. That's what we'll discuss today, is 3 different strategies that we can utilize to save money on taxes and have those dollars go to work for you, compounding over time. My name is Paul Brandwein with Playbook Wealth Partners. We work with concentrated stockholders, business owners, and real estate investors, all trying to exit those positions in the most tax efficient way possible. Today's video is for educational purposes only, does not constitute investment, legal, or tax advice. If you enjoy the video and you want to talk about your specific situation, we would love that opportunity, but today is just for education. I hope you enjoy. Leading up to your business sale, the clock starts 3 years before the sale. Every business advisor that you'll meet with, every M&A advisor is going to tell you 3 years before, you want to make sure your books are squeaky clean, you're not taking unnecessary deductions, and a whole litany, I'm sure, of other pieces of advice that they'll tell you about the business specifically in order to get the most dollars for your sale. You should listen to them. What they're going to tell you is going to be valuable information. Listen to your CPA, listen to your attorney, listen to your business broker on the business side. On the personal side, same rule applies. Before the sale, there are things that you can start to do in order to set yourself up for success following the sale. Specifically talking about tax management. So when you sell your business, you will have a capital gain. There are strategies that we can put in place that are going to help mitigate and defer that capital gain so that it's much more manageable over time. The first strategy, pre-sale, that we can implement to save money on taxes is going to be tax loss harvesting. So tax loss harvesting is a way to build up paper losses, so not realized losses, but losses on paper that we can use to offset actual capital gains from your business sale. So what we would do is we would take post-tax dollars and invest them into the market, into a strategy that's designed to systematically harvest losses while maintaining exposure to an underlying index. Let's take the S&P 500, for example. We would invest dollars into the S&P 500, and we would buy the individual stocks in the S&P instead of an ETF that covers the whole 503 companies. So let's say we purchase 350 of them and we leave 150 on the bench. If we own JP Morgan and one day JP Morgan has a bad day, we're going to sell JP Morgan, and then we have Goldman Sachs on the bench. So we'll replace JP Morgan with Goldman Sachs, maintain the same exposure to the index, but bank that loss so that we can start to build up those losses. So we do that every day, and over time, we'll create more and more losses while we continue to participate in the index. The longer runway that we have to implement that strategy, the better, because we can start with a $500,000 account and we can harvest losses for 5 or 10 years leading up to the sale. You'll have a nice pool of losses that you can use to offset some of those gains. Strategy number 2 for pre-sale slash post-sale, it's a hybrid because you have to set it up. You have to set it up pre-sale, but then it's going to benefit you post-sale. The second piece is going to be setting up an installment sale. If you can do seller financing or a sell and stay kind of situation, that's going to benefit your tax situation because you're going to be able to spread out that gain over a couple of years versus having one lump sum payment that you have to deal with all in one tax year. So basically what we're doing is we're continuing to tax loss harvest, continuing that engine to build up paper losses. But instead of having to use them all at once to offset that gain all in 1 year, we're taking that $5 million and we're spreading it out over 5 or 10 years. So instead of $5 million capital gain in year one, you have a $1 million capital gain or a $500,000 capital gain in year one. And then in subsequent years, same deal. So if we can take some of the proceeds from the installment sale and invest into that tax loss harvesting engine, then we can continue to add gas to that fire and then really increase the paper losses. The third piece is going to be the same deal at the sale, following the sale. This is going to be a charitable piece. If you are a business owner who donates to charity, not just for the tax reasons, but because it's who you are, it's what you want to do, there's strategies that we can utilize to optimize and to maximize the dollars that you give to charity. Specifically, in year one, if you have a large lump sum, front loading your charitable giving into a donor advised fund can lower your taxes for that year. So instead of continuing to donate whatever percentage that you donate, you can say, hey, over the next 10 years, I'm going to give $1 million to this charity. I can put that whole million into a donor advised fund in year one, get all of the tax benefits in that year. So that would be a better situation if you had a lot of ordinary income from the sale as well, goodwill or assets that are in the business that are going to be taxed as ordinary income versus long-term capital gains. This donor advised fund would be a way to lower your tax liability on those specifically. And if those are not as big of a concern, you're mostly looking at a long-term capital gain, they can offset the long-term capital gain as well. So putting it all together, what we can do is we can look at pre-sale, starting to tax loss harvest, setting up an installment sale, looking for a buyer that's willing to do that if you want to go that route. At the sale itself or following the sale, looking at your charitable giving and decide if that's something that you want to do. And then continuing to tax loss harvest either with the proceeds from the sale itself or with the proceeds from the installment sale as you go forward. So those are the strategies that we can implement, that we can put together in order to harvest losses and to defer that capital gain. Okay, so let's make these numbers a little bit more real. So let's assume that we have a business owner selling a business for $5 million. So sale price is $5 million. Total capital gain on that $5 million is $5 million. The total tax owed is 1.4. So after tax proceeds is what you're actually going to take home is the 3.56. So if we go to the Playbook, we have a couple of different options, and this calculator is available on my website, playbookwp.com, if you want to play around with it. But we can decide a couple of different things. So the most conservative that we can select is a 10% tax loss harvesting per year. We're going to implement our charitable giving strategy. 5% of the proceeds are going to go to charitable giving. This does not assume an installment plan. So this is just one lump sum. The pre-sale tax loss harvesting, we're investing $500,000 5 years ahead of the sale. So what that means is we're going to be able to build up cumulative losses of $250,000 leading up to the sale, which is going to offset taxes by $71,000, give or take. An additional $70,000 is going to be offset by the donor advised fund. So our total tax savings there is $144,000. Now what we can do is we can add an installment plan. We're going to do seller financing, and basically we're not going to have this large $5 million chunk hit our bank account in 1 year. We've got time to spread it out. So now we're doing the charitable giving, we're adding installment plan, and we're doing the pre-sale tax loss harvesting ahead of time, and we're doing tax loss harvesting on the proceeds following the sale. So every time there's an installment plan payment made, we're taking a percentage of that and we're putting it into the tax loss harvesting account. So you can see that the tax savings numbers jump, and The reason being is because we're spreading these out over time. We're adding more and more losses, deploying more capital over time. It's going to give us more dollars in losses that we're able to use to offset those gains. We can change the percentage of tax loss harvesting. We can make it moderate or more aggressive. All that you can play with on the website. But what I want to show is what happens long term, which is pretty cool, is this growth projection chart. If we take those tax dollars and we invest them into the market, what is going to happen to our total account value down the line? The red line here shows if you paid all the taxes up front and you took the 3.5 million and you invested it into the S&P 500. This assumes a 7% annualized rate of return. So 7% per year for 20 years, your 3.5 million turns into 13.8. If you implement the most conservative tax strategy from the previous page, you're over $1 million better off. So 1.2 million in the conservative, 3.4 million in the moderate, and $6 million of additional capital that has grown because we implemented a strategy up front. So this is the power of tax loss harvesting. It's not just about how many dollars can we save before the sale? How many dollars can we keep and not send to the IRS? That's all part of it. And that's a great story to tell your buddies at the golf course is, hey, you know what? I was supposed to owe the IRS 1.4 million and I ended up only sending them 200,000. Great. What's a better story is, hey, I was supposed to have 13 million. Now I have almost 20. So the power of compound interest is incredible. If we can harness it and we can put more dollars to work, every dollar saves in taxes is a dollar that has an opportunity to compound. So what we encourage business owners to do is to think about this tax savings piece as a part of their overall portfolio, making those dollars go to work for you versus sending them to the IRS where they're not doing work for anybody, frankly, depending on who you talk to. But those are the strategies. That's the power of what happens when you take these dollars and you invest them in the market. If you're a business owner and you're at all interested in learning more about any of these strategies, we would love the opportunity to speak with you. You can book a call using the link in the description below. You can find out more information on our website, playbookwp.com. Thanks for swinging by for today's video. Hope you tune in for the next one. Take care.